Good evening, everyone. This is Rich Checkan from Asset Strategies, and I'm here with my co-host Adrian Day of Adrian Day Asset Management. We were expecting to have Larry McDonald with us. Really looking forward to getting his insights on listening to the marketplace and so forth. I can only assume there's some sort of technical glitch on his end. We're trying to work it out, and I hope he'll join us. But for those that are with us, we're going to go ahead and get started. And you all know Adrian very well. His reputation precedes himself. I was lucky enough to spend some time with him last week down in Boca Raton at Rick Rule's Investment Symposium. I know I took a lot of information away from the symposium, a lot of great conversations and a lot of good information shared. I'm sure Adrian is going to say the same. And while we wait and hope for Larry to show up, we're going to go ahead and get started. So, Adrian, do you want to kick us off with maybe some of the high points you saw down at the Rule Symposium?
Yeah,
or in
well,
the
thank you.
markets in general? It
Yeah,
doesn't have to just be there.
thank you very much, Rich. And to everybody watching, I'm keeping my eye on my phone in case Larry gets in touch. He is very reliable, but he does live in Panama. And since I live in Costa Rica, I know sometimes things happen, and sometimes internet goes out and there's just nothing you can do about it. So
Yeah,
anyway,
it is hurricane season too, I might add. So
sorry?
it is hurricane season too, isn't it? I know we're getting some storms here in Maryland.
Panama actually doesn't get hurricanes, which is one of the reasons that people like Panama over, say, the Caribbean islands and further north. Anyway, yeah, both Rich and I were at Rick Rule's resource symposium, he calls it, to make it sound fancy. His resource symposium. I don't know how many people listening were at that conference, but I thought it was just an incredible conference. One of the things I really like about Rick Rule is because he's in the business, he knows what his audience wants. He's not, how can I put this politely? He's not a seminar promoter putting on a well-organized seminar. He is an investment professional who is trying to give people content. And the content was fabulous. A few takeaways I had. I think the mood was much more upbeat than it has been, certainly. And both from the podium, as well as from the attendees. I mean, Robert Friedland, as one would expect, delivered value, but he made a very compelling case for copper, very compelling. All of the coming uses of copper on the grid, on Bitcoin, on electrification. Excuse me, all of these new uses of copper. That's in addition to the infrastructure and the housing, which, we need anyway. It was also, to me, I'll stop here, but one of the highlights for me was listening to some of the people who have been in the business for a long time. I sort of have an affinity with those people who've been in the business for a long time, who have been successful, and telling us what made them successful, as well as, frankly, just listening to them and inferring what made them successful. For example, Sean Boyd. Sean Boyd is now the chairman of Agnico Eagle. Agnico is the third largest gold mining company in the world, but he's been with that company virtually 40 years, most of that as CEO and president. So most of that, he was running the company. He just stepped down last year. And built it from, I won't say nothing, but very close to nothing when he joined, built it into the third largest gold mining company in the world. And a few things struck me. One is he said, a lot of people talk the talk, we don't want to be the biggest and so on, but in the case of Agnico, he made it very clear that they have no intention of just growing for the sake of growing. And when he started out, absolutely no thought that they would ever be the third largest gold mining company in the world. And I think they've done it by having Well, a few things. One is by having very good people with a very deep bench. I don't know if you listened to Sean, but Sean Boyd, I've met him many times. We own Agnico. It's actually our largest holding. I don't know if I should disclose that or not.
Too late, disclosed.
But he was, he was clearly a very nice person. He is very clearly a very nice person, a very competent person, and a quite humble person. And those are characteristics that I think actually help with success. And he did. I think they built a company by having a very, very clearly defined vision of what they wanted to be, and what they did not want to be. And he made clear what they do not want to be is a global mining company with mines all over the place. And the growth sort of just happened to come along because they were successful at what they did. I think we had a lot of discussion. I'll stop here. We had a lot of discussion at the conference. It was part of my speech, part of my talk, in fact. We had a lot of discussion about the apparent disconnect between a gold price that has been very strong, gold stocks that have been reasonably strong in the recent past, but still haven't had the leverage that you would expect to gold. But at the same time, we're seeing outflows from the GLD.
Yeah.
We're seeing coin premiums low. You can talk to that.
Yep.
And we're also seeing outflows from the GDX. Most I manage Peter Schiff's mutual fund, as you know. Most mutual fund managers that I talk to are saying they are getting consistent withdrawals, consistent outflows. So the disconnect between those two, I think, was something very, very interesting. And I'll leave that hanging, and we can talk about that if you want.
Yeah, no, I'd actually like to pick up on that thread. That's one of the things I covered in my presentation on Wednesday on Gold Day. But I've got to agree with you, compared this year to last year. Maybe it was just my impression, but I thought there were more attendees, for one, so there were more people there. Two, absolutely the spirits were much higher. And I think across the board, people are starting to believe that we are in a commodity super cycle here. And across the board, it's not just precious metals, it's copper, it's other things. So I think everybody's getting a little excited about this market. Hopefully not too excited. And I don't think the price action is getting away from us. This is not irrational exuberance, but I do see it building a little bit. So I noticed the same thing you did. When it comes to the ETFs and gold, there's no question. We've been consolidating at all-time highs for 5 years. I know you've heard me say this 30,000 times if you heard me say it once. Gold at all-time highs is dirt cheap. Silver at 60% of all-time highs is even cheaper. And that theme was out there. I talked about the stealth market, where we have these all-time highs for 5 years, but who the heck is buying it? Because when you look at the ETFs, there's this giant sucking sound. Metals leaving the exchange traded funds. It's not going into it, especially in the West. And what we know is for the past several years, central banks and Asian investors, for the most part, have been buying. We're starting to see a bit of buying from family offices as well as they get a bit nervous about the upcoming elections in November. But that's where the buying's happening. The selling is happening in the West, Europe and North America. And I want to say that, the previous month or quarter, I got it mixed up. I had the numbers right when I gave my presentation, but there were, I want to say 1.47 trillion dollars worth of income into the ETFs. And they were all excited about that. But I think it was like 6 point something trillion that had left prior. So we have this big void to fill, even though we had just one, uptick, if you will, in the short term. I'm seeing the biggest transfer of wealth, real wealth, gold, from west to east. We've talked about this, my 28 years in the business. I'm seeing it before my eyes more so than I ever have. I don't know your thoughts there.
Yeah, that's definitely one factor, the transfer of wealth from east to west. And we're seeing with the gold, physical gold, leaving the LBMA and leaving Swiss vaults and so on. I think there's another factor right now, and bear with me. When you look at who's been buying gold, now leave gold stocks alone for a moment. As you said, it's the central banks. China has been, until the last couple of months, the dominant player, but
Yet central bank buying has not dropped off, even with China dropping out for 2
exactly.
months. Yeah.
Other banks are buying as well. And yeah. And then secondly, we have Chinese consumers, retail, whatever what we want to call them, but Chinese investors buying.
Yep.
And in both of those cases, the motives, there are very clear motives for these groups to buy physical gold, and they have very, very little to do with the macroeconomic environment. So we know why central banks are buying, because of the weaponization of the dollar, and they want to diversify their reserves. Chinese buyers are buying because they're concerned about the economy. They're concerned about the banking system. They don't want to put their money into real estate for obvious reasons, when pretty much every Chinese real estate company is on the verge of bankruptcy. Stocks, as a contrarian, I think Chinese stocks are a good buy. But when you're a Chinese person and stocks have done nothing but slide down for pretty much 2 years straight, maybe that's not the best place for a defensive position. And of course, they're not allowed to buy crypto. So gold is the obvious place. Now flip to the Western investor, right?
Yep.
And you look at the environment, ignore for a second what you and I and other people might think about the future. Ignore what we think is the reality of some of these government statistics. But if you just take a snapshot of where we are right now, we've got high interest rates, we've got low inflation and inflation coming down, we've got a strong economy, we've got a strong dollar, and we've got a strong stock market. That is precisely the macroeconomic environment where you don't want to be in gold, right? Except as a defensive insurance. And so I don't think there's any illogicality between, sorry, is that a word? Between
it is now.
Eastern people buying and gold going up, but people in the West not buying. I don't think I don't think that's illogical. Now, again, you and I, by the way, I should ask, if you have any questions for us, please do put them in the Q&A, and we'll get to that.
Good point.
I'm sorry, we're both looking at our phones to see if we get any messages. Sorry. You and I are both people, obviously, and other people. We look ahead, so you don't just take a snapshot. And when you look under the hood or under the bonnet, as we would say, the economy isn't as strong as it would appear. Employment in the US is not as strong as it would appear. The consumer is nowhere near as strong as it would appear. The stock market, yes, the S&P up until today, the S&P was at all-time highs, but NVIDIA represents 50% of this year's gain. A single stock represents 50% of a gain. The dollar, the dollar's strong against every other bit of paper, but it's lost over 20% of its purchasing power in 4 years. How strong is that? I don't.
It's stronger against other currencies. That's all we can give it.
Exactly. So when you look at all these things, and then you think that inflation, although it's come down a lot, is still stubborn. 3.5% CPI is, what's that? That's 60% above the Fed's own arbitrary target. So inflation, in my view, has not gone away by any means. Or let's just say it's I'll be very conservative about it and say it's premature to say that inflation has been killed. So when you look at all the factors out there, they're all, one by one, they will move in gold's direction. And I think they're going to move in gold's direction, over the next 6 months, frankly, before the end of the year.
Yeah, so look, first off, thanks, Tony, for the nice comment that we're doing fine and to keep going, that you wanted us to cover the symposium. There's another way to cover it. I'll just throw that out there, but you can get the virtual or sign up for next year to join us. We'd love to see you there. It is one of the best shows we attend every year. So thanks again, Tony. You know, while we were down there, a couple things happened, and it definitely pushed the gold price higher late last week and into this week. First thing was Fed Reserve Chairman spoke in front of Congress. Jerome Powell spoke in front of Congress a couple times last week, or Congress and the Senate, and gave his semi-annual testimony. And basically, what he said is that more than likely, what you're going to see from here are not interest rate increases, but interest rate cuts. Okay, so the market heard that loud and clear. They went dovish versus hawkish. He didn't say when, he didn't say this year or anything like that. But right away, everybody said, okay, here come the cuts, and they're coming in September. Couple that with Friday's figures for the CPI, which came down, 0.1%, which is virtually nothing from a number that I don't think either one of us give much credit to, that 2% target. But it did come down 0.1%, and that just added fuel to that conversation, fuel to that fire. I'm seeing calls now, Adrian, for 3 rate cuts of 50 basis points each by the end of the year, September.
That's not going to happen.
Yeah, I know, I'm with you, but I'm seeing that, and that's what this conversation last week spawned while we were there. The one thing I just wanted to touch on here is, when they come, and I think they are coming. I don't know if it's happening this year at all, let alone 3 times. But when they come, historically, what happens is that's positive for the gold and silver price. We tend to see double and triple digit increases in gold and silver once the first rate cuts begin. We saw it in 2000, we saw it 2006, we saw it 2018. I don't see any reason why we're not going to see it in 2024, 2025, whenever the rate cuts start. What are your thoughts on that?
Yeah, I tend to agree with you there. I must admit, first of all, I'm not one of those people. I was not one of those people that thought the Fed was going to pivot immediately they started raising rates.
Yep.
But having said that, I have to say, after Powell's extremely dovish presser at the end of last year, remember, in December?
Yeah.
I really thought we were going to get some rate cuts this year. Yeah. I think Powell, everything we know about Powell, and talking to people who know him personally, Powell, first of all, let me say, I have nothing good to say about the Federal Reserve as an institution. I do think Powell is better than the last couple by a long shot. And I also think that Powell is someone who is trying to balance. I mean, by the time he came in, I think the war was already lost, frankly.
No question.
And they were already facing an impossible situation. So having said that, I think Powell is someone who's concerned about his legacy. This is what everybody tells me who knows him.
Yep.
You heard that at the show.
I've heard that over and over.
Several people. Daniel DiMartino Booth, for example, has mentioned that. Yep. And he definitely, I think Powell would be happier to leave office with the economy in a recession, a mild recession, but a recession with inflation under control, than to leave with inflation moving back up again. So although he talks about the different objectives, the different mandates that the Fed has, he's clearly focused on inflation. And, he's absolutely right when he says inflation is central, because if you have high inflation, that hurts everybody. And it hurts working people, poorer people, the most.
Agreed.
They don't have the opportunity, to benefit from asset inflation as much as wealthier people. So I think he's going to be. He clearly wants to cut, but he doesn't want to cut before. He doesn't want to cut too soon. I can see that.
Well, you
I
know, I'm
just
not.
ask,
Okay.
sorry?
I was gonna say, I'm not a big fan of Jerome Powell. And I just don't think, over time, the whole transitory blaming inflation on other people and other governments and other factors other
Yeah,
than the fact that they created it. And I think last year they were absolutely wrong, and still are absolutely wrong on the strength of the households. I mean, we're seeing now that non-mortgage household debt is higher than mortgage household debt. And I'm pretty sure that's the first time ever, right? That's not good. That's not positive for the households. That is not a strong balance sheet, as he says. The other thing is, we've got credit card debt now up to 1.27 trillion. Every time we do a webinar, we're hitting some new peak there. And I don't think there's much more of a peak to summit here at 29% interest. So the household finances are in shambles. But you also know, I'm not an apologist for him, but he didn't create this problem and he cannot fix it with interest rate manipulation. Congress needs to balance a budget. Until they do,
sure.
he's never ever going to solve this. He cannot.
Yeah, let me just, I hope nobody got the wrong idea from what I was saying. I think he's better than the last two. And in fact, I would say he's even better than Greenspan, because Greenspan was someone who knew better.
Yeah.
Greenspan started this with that Fed put. But anyway, no, I hear everything you're saying, of
Where I
course.
wanted to go with it, I do want to get to the questions. Just my quick question for you is, do you think he's right now just trying to tread water through the election because no matter what happens, he's going out the door and
Um,
this is his legacy? Just keep it intact and whistle a tune and keep people at bay until
no,
then.
my sense is that he really is itching to cut rates. And he's got people on the Fed committee. Let's not remember, this is not a
It's not
one-man
his call.
show.
Yeah.
He's got people on the Fed committee that want more cuts. You look at the Fed dot plot from last month or 2 months ago. The typical Fed member is still calling for more rate cuts. I think he wants to cut rates. This month would be obviously better than later, because the nearer you get to the election, the more difficult it is to make any changes to monetary policy. Whatever they say, Powell, it's disingenuous to say we don't even think about the election. Of course they do. They know it's there, and they don't want to be seen as political. So maybe they could do it in September. But if it's not September, then it's after the
Forget it.
election.
All bets are off. I'm with you there.
Yeah. Can I just answer that first question
Yeah, I
and
was going
then
to say we
let you
should get to
answer
some
the
of
other
those.
two?
Yeah,
I
I
don't
think
want
the
to.
first two are related here. So
Okay, and I don't want to. Obviously, I don't want to dominate, but let me answer the
no,
question that came in. But somebody said in one of my books, I indicated that in a recession, gold will go up because of the Fed's response to a recession. Can you elaborate? Yeah, so two factors there. One is theoretical and one is empirical. Markets are always forward-looking, and that's why you often have this phenomenon of bad news, market goes up. Huh? What's that all about? Good news, market goes down. What's that all about? Well, markets are forward-looking, and in the case of recessions and gold, obviously, if the economy slows, then the market thinks the Fed is going to start cutting rates. And as Rich said earlier, the first Fed rate cut is always the sign for gold to move up meaningfully. And so the deeper a recession we have, the more the market thinks we're going to get more rate cuts, and the more, therefore, gold moves up in response. So gold is moving up not in response to a recession.
Yep.
Gold is moving up in response to forecasted expected rate cuts. And then empirically, if you look back at every recession in the US back to the 1960s, gold, and you just take the recessionary period, not the period before when people were expecting it, or the period halfway through when it was already ending, but just look at the formal recession. I think we've had 9 recessions in that period, and in 8 of those 9, gold went up. The only one it didn't go up in was in 2000 when the European central banks were dumping their gold, if everyone remembers that. The European banks were dumping their gold, and even then, gold fell by less than 0.5%. So empirically, the evidence is very, very strong. And I did something that is very naughty, and you're not supposed to do it, and I hate it when other people do it. But I manipulated the data, and instead of looking at the actual recession, I looked at 2 months after the recession started. And then in every single recession, gold was up. Gotcha. So give people a couple of months to think about what they want to do, and gold goes up. Gold stocks, interestingly, because this is even more, perhaps this is more counterintuitive. Gold stocks went up in 5 out of the 9, so in a majority. But in the ones where they went up, gold stocks went up by between 30 and 100%. In the ones where they went down by 5 or 10%. So the average was, quite strong. And lastly, on the last point on this, even in the recessions where gold went down, gold stocks went down, they outperform the S&P. So the lessons to me are very clear. If you think we're having a recession, 1, buy gold, 90% certainty. 2, buy gold stocks rather than the S&P.
Good stuff. Good stuff. And I think that Peter asked a question: why are they not coming sooner? I assume he's asking about rate cuts. And I think you've already covered that. If not, Peter, let us know. But the bottom line is, they learned a lesson, I think, in the 70s. I don't know if they really learned it or know the answer or the solution, but they know what they don't want to do, which is start cutting rates too soon, and then let inflation re-entrench itself and take it to a new level. And that's what happened in the 70s. They do not want that to happen again. In fact, he talks about it virtually every Q&A session after the Fed Open Market Committee meetings. So that's why we don't think it's coming sooner. But we also know that, we've got $30 trillion in debt, and that's a lot of money to finance at higher interest rates. So those rates are going to have to come down. There's no two ways about it. All right. Let me see. All right, Peter, thank you for that. Yes, we answered it. David Olivero, Richard, where do you think the monetary demand for silver is coming from? I read where the Chinese government is encouraging its citizens to buy silver as well as gold. What are your thoughts? Yeah, in any bull market in precious metals, and we can really only talk about 2. This now potentially is our 3rd, since they closed the gold window in 71, August 15th, that fateful day where Richard Nixon said, no mas, you can no longer convert gold for the dollar. Since then, we've had 2 bull markets from 71 to 80 and from 2001 to 2011. And both were massive for gold and silver. And they both started with gold leading the way. And we fully expect and have seen so far in this bull market, gold to lead the way. It's the primary monetary metal. Once it gets going, silver will follow, and then it tends to outpace. It did in the previous 2. A lot of us expect that to happen again. And you're asking, where is that going to come from? I think it comes from gold investors. People that want to own monetary metal look for diversification as they start buying it. And silver is the natural next step for divisibility, if you will. But it's also the next step when people start thinking, well, gold is expensive. Because they call silver the poor man's gold for a reason. It's $31 an ounce or 30 and change here today, versus $2,500 an ounce, which is where gold is. So a lot of investors will want to participate in that precious metals bull market, but they can't buy an ounce of gold. They don't have that liquidity. They'll buy some silver. I know when I first started, I was one of those buyers. When I first started at ASI, I couldn't afford an ounce of gold. I just moved in from other things. I was prior service, and then I was selling door to door. And then I came here, and I wasn't able to. So what did I start buying? I started buying silver at 453 an ounce. Okay. And that seemed like a lot, but I did it and I built it up until I could parlay that into some gold and I could buy ounces of gold on my own over time. But that's where a lot of people will start. And that silver market tends to move quicker than gold because it's a smaller market, it's less capitalized. And the same amount of money in that market has a much bigger impact on the overall growth. You want to add something there?
Yeah. No, everything you said is 100% true, and you know, it's called poor man's gold for a reason, of course. I noticed in when I met your uncle in Las Vegas,
Yeah.
he very kindly gave me a silver coin.
You mentioned he did that. I saw.
He's still giving out silver coins, but the time will come when he want to be handing out silver coins. But he certainly didn't he didn't offer me a gold coin. But I was very happy and thank him. What was I going to say? Yeah, there's a couple of things about silver that are really interesting. Silver has why silver can outperform gold. When the market gets going, the percentage of buying that comes from speculative retail investors is that much higher than it is in gold. And so when silver starts moving, you know, you start getting, I won't say the Reddit crowd in any disparaging way. The Reddit crowd wasn't around in the 70s, but you get much more, shall we say, enthusiastic speculative buying of silver. So the speculative amount of total buying tends to be higher. The other thing, which is a little more esoteric, but bear with me, you know, in gold, most gold comes from primary gold mines, and some is a byproduct of copper. But the vast majority comes from mines that are where their primary metal produced is gold. For silver, that's not true at all. At most, 30% of silver production comes from primary silver mines.
Pure plays, yeah.
And when we say, when I say primary, I'm not even talking about a pure silver mine. Now, that means at the minimum, my number's more like closer to 80, but I'm using 70 because I got that from Michael Stedman of Pan American. 70% of your silver production is byproduct, not of gold, which would be okay because they're both monetary metals, but is byproduct of base metals like lead, primarily lead and zinc. What this means is critical, because what it means is that when the price of silver moves up, even over a sustained period of time, the producer of silver does not change his production of silver in response to changes in price. In other words, the Bolivian lead producer is not going to produce more lead just because the price of his 8% byproduct silver went up. We're talking a very small amount of byproduct silver. And so you get this phenomenon on the upside. You also get it on the downside. If the silver price were to go back to $4, no zinc producer is going to say, well, that's it. I've finished producing zinc. Forget about that. No, in fact, many of the base metal producers, the lead and zinc producers, will even use the price of the proceeds from their silver byproduct as a deduction to their cost. So they don't even look at that as a profit generator. It's a reduction in their cost. And so again, so silver production does not respond to changes in demand.
Yeah, that's a great point.
Important factor.
Yeah, great point. Very inelastic. So, you know, the takeaway is, you know, if you want more silver, you can't just flip the switch and start making more silver.
And there aren't any stockpiles. There are no big stockpiles.
Well, and that was the other thing I was going to say. It's why we see things like we just saw, which was like 11 years of surplus production of silver, right? And then in 2 years of deficit production, all of that's wiped out. That's what we saw in the past couple of years. So, yeah, silver is very interesting, especially since it's going to be becoming more and more demand, not just from investors, right? But from industry, as green technology kicks in, they want to build more solar panels and everything else. Silver is going to be demanded more. And again, you can't just flip that switch. So that's important to keep in mind. Yeah, silver's
Hey,
pretty
I'll
exciting.
let you answer the question on artificial intelligence.
Thank you. I was actually hoping I could get ChatGPT to answer it for me. But did I say that right? ChatGPT? I don't even
That's
use
hilarious.
But yeah, it's kind of interesting. The question is from JJ, and thanks, JJ. How do you think gold will react to artificial intelligence robots causing massive deflation in the next 10 years? These robots will be able to do almost any task they're programmed to do. I really don't know. I'm not an AI guru, but when you talk about deflation, I do want to raise just one point, and that's everybody thinks of gold when inflation, right? The first thing they think about in gold is like gold price is going to go up because of inflation, and then when it doesn't, like a year or two ago, they're like, why didn't it go up? Everything's inflated. Gold price should be going through the roof. What a lot of people don't realize is gold actually does really well in a deflationary environment, right? It's a store of purchasing power. So when everything else is losing its value, gold tends to hold its value. We actually saw this, 2 years ago or whatever it was, when the stock markets collapsed, the bond markets collapsed, everything fell through the floor. And gold, it didn't do great. I think it was up, 3% or something on the year. It was virtually flat. Yet it completely and without a doubt outperformed virtually every other asset class because all it did is just not fall as fast. It just held its value. So in a deflationary environment, I actually like gold a lot. I don't know your thoughts there.
Yeah, I've talked about this before. I think even on these webinars, there's a great book by Professor Roy Jastrom. He's deceased now. It's called The Golden Constant, and he looks at the annual cost of living, the annual price of gold, and the annual purchasing value of gold annually in the US back to 1810 or something, and in Britain he goes, well, year by year he goes all the way back to like 1540, and then he goes all the way back to 1215 Magna Carta, with a little bit of intermittent gaps. And basically what his conclusion was, but on a relative basis, not in a nominal, not just in nominal basis, but in a absolute and in a relative basis, gold actually does better in deflations. Yeah. Because in inflations, let's face it, there are other things that do well.
Everything's going up.
Does well, old automobiles do well, diamonds do well. Often real estate does well. In strong inflations, the stock market performs well. Just look at Zimbabwe, for example.
We're seeing it right now, I think.
What?
We're seeing it right now, I think.
Yeah.
In our stock markets.
Well, yes, in the US. And so, but in a deflation, there are relatively few things that perform well. So no, I agree with that. Shall I answer? Does everybody see these questions, or is it just us?
I think, I don't know. I think it's good to go ahead and read it, but I think everybody sees them.
Okay. So Peter is asking what investors can do to protect their wealth from the Labour government. And since Labour is spelled with a U, I'm assuming he's
clearly
talking
from
about
the
Great
US.
Britain. Good guess, right? A few things. Let me think. First of all, I don't think this Labour government, I may be wrong, I'm not saying they're going to be a good government, but I don't think this Labour government is going to be, as bad as some Labour governments that we've had. So I think they're going to be reasonably cautious on raising taxes. And let's not forget, it was the so-called, and I will say so-called conservative government that was in office for 14 years, but gave Britain its highest individual tax rate since the end of the war. And the war I'm talking about is the Second World War, not the Iraq War. So we hardly had very good free market conservative policies under the conservative government. Let's not forget that it was a conservative government that got rid of the domicile status, which was very beneficial to Britain, frankly. But politics of envy. We don't like rich people moving here and having benefits, and so they did away with it. And of course, what's the obvious conclusion? Wealthy people are leaving Britain, right? So I don't think that the Labour government is going to be so bad. It's certainly not night and day compared with the Conservative government. The Conservative government. So having said that, how do you protect your wealth? Frankly, I think British stocks are still quite cheap on a price to book, on a yield basis. They are quite inexpensive, and they're quite inexpensive on a historic basis. And this goes back maybe 20 years. You compare British stock valuations today with how they were 20 years ago, and they're really quite undervalued today. If we see a pound devaluation, I don't mean a devaluation, but if the pound loses value against other currencies, against the euro and against the dollar, that will of course help the exporters. And Britain being a small island, most of the stocks are exporters. It has a much higher percentage of exporters than, say, the US market. So I think the stocks will do well. I think obviously gold is a place to put money. And as always, I mean, I think one has to keep an eye on possibilities that may not happen. And I'm thinking of exchange controls. I mean, my very first trip abroad was when I was a student back in 1970, and we had exchange controls under the Labour government then. You could only take £100 out of the country. Can you imagine that? Now, as a student, that was enough for me to have a good time. But I mean, can anyone now imagine only being able to take, even adjusted for inflation? And so I think one needs to look to, put some money out of one's own country. I don't know if that answers the question.
I think that's a good point. You finished on is the plan B. I know when I first got here, my uncle Michael's partner, Glenn O'Kirsch, I know you know him very well, and many of you listening knew Glenn very well. He always used to say, the time to get your a foothold, offshore is not when the government is slamming the door on your foot. Right. So bottom line is look for your plan B when you have the opportunity to look for your plan B, and hope you never need it. Plan for the worst, hope for the best type of thing. So thank you for that question. Like to know your thoughts about how a significant stock market correction will impact the gold and silver price before we see the bounce up in the metals. Okay. I'm not really sure. I think, if you see any sort of panic in the markets, okay, initially, at least short term, we tend to see gold and silver fall with the markets. Correct me if I'm wrong, Adrian, but I know when the news, for instance, came out about Bear Stearns or AIG and things of this, Lehman Brothers, initially the stock market fell. Initially, gold and silver fell too, and that's usually because people or investors have positions that are leveraged. All of a sudden, the market falls. They have a margin call. They need to go where they have liquidity to go ahead and meet those margin calls. And some of the most liquid markets in the world, period, hands down, full stop, are gold and silver. So we see those sell off. So the investors can then go ahead and meet their needs, meet their margin calls, save their positions, if you will. And then right away, we see the gold and silver markets within days and a week or so come right back up as bargain hunters move in, swoop in, and start picking off gold and silver at a artificially low price. So I would expect to see, if there's any sort of precipitous drop in any of the stock markets, I would expect to see gold and silver go down. If it's kind of like a slow moving train exiting the cliff, like a lot of people feel like they're viewing right now, I think we're going to see just a slow, steady increase in the precious metals prices. But if you see a precipitous fall, I would not be surprised to see gold and silver dip short term. And if it does, I think the old quote from Doug Casey and others was back up the truck. If you see that.
No, absolutely. No, you're absolutely right. And one other thing I'll add to that, if you do have that precipitous drop, and we saw it in 1987, we saw it in 2008, you know, both times the stock market dropped sharply. And as you say, people look for liquidity. But in all of these cases, gold moved back up very, very rapidly. So you look at 2008, for example, let me see if I have this right. You look at 2008, gold peaked in August. The stock market peaked, I think, in September. Gold bottomed in October, the next month. And gold stocks were already up over 50% before the S&P started to move, before the S&P bottomed and started to move back up. So even though gold stocks will drop in a sharp decline, they tend to move back much, much sooner. And you've dismissed a question, so I've forgotten what else he was asking. Oh, yes.
Oh,
Again,
sorry.
I think, you know, every situation, of course, there can be other factors that come to play. But typically, what we see in a recession is obviously gold goes up for the reasons we talked about earlier. But if you think about stocks in a recession, and particularly if you still have some inflation, so you have a sort of stagflationary period, then corporations are finding that their costs are still going up or not coming down, but the demand for their products is also going down. So profit margins start getting really squeezed. And so when profit margins get squeezed, then stocks go down. So in fact, stocks typically do not do well in recessions. And I mentioned the statistics on the S&P. I didn't mention all, I don't have them at the top of my head, but I mentioned that gold stocks did better than the S&P during recessions. And the S&P will only start to move up towards the end of a recession as the impact of rate cuts comes into play, and as the market starts to look forward to the end of a recession. But during a recession, profits get squeezed and stocks don't do well.
Good stuff. All right, and thanks, Adam. I see that you guys are seeing the questions. I think we'll still read them just so we can cover them, and I'll try not to hide them until we're done answering them, Adrian.
Yeah, because I've got to answer the question. I don't want to be a politician just rambling on about what I want to say.
Gotcha.
Do we want to talk about call options or not?
Yeah, it's not something I do. Do you want to handle that one?
Yeah, I don't actually do call options in gold. And the reason is really quite simple, because for me, the physical gold is an insurance and a protection. And by their nature, call options are speculative, however, you know, in the money, however close to the money, however long-term, whatever. I do, however, do options with equities, the gold stocks. And
is that usually to buy well?
Sorry?
Is that usually to buy well?
Yeah, I mean, there are different strategies that I employ, but the most frequent one is the most simple one, and that is to sell puts on things that you want to own. And then you're very happy with either outcome. If the stock is put to you, well, you were going to buy it anyway, and you get to buy it at a cheaper price. And if the stock's not put to you, well, you pocket the income. And gold stocks are very, very good for selling options because they tend to be very volatile. They're very volatile on a long-term basis, but also on a short-term basis. And as you probably know, in options, one of the key criterion for how large your premium is how volatile the stocks are. So, you know, you try and sell a put on a treasury bill, you don't get anything for it. But if you sell a put on a gold stock, you can frequently get as much as 5% or more on a close to the money, but under the money, out of the money option in 1 month. You know, let me say that again. You can get 5% on your money by selling an out of the money put on gold stocks just because of the volatility. So I do that a lot. I do sell calls, but typically the danger with a call, of course, is that the stock gets called away from you and you never get to buy it back. And so you can't really say that either outcome is a good one.
Yeah.
If you believe in a gold bull market. So for me, selling calls on the gold stocks is very much client, you know, I'm talking about my clients here, very much client specific. If I happen to buy, I don't know if the SEC will let me say this, but if I won't name a name. If I happen to buy stock A at a particularly opportune moment, and now the client has, you know, 12% of his account in a single stock, I'm happy to sell calls on half the position. And again, the premiums on calls can be astonishing, and you can sell calls that are way out of the money, but you really genuinely don't think will ever get called, and you can still pocket income. And then lastly, what I think the guy is, I can say guy because he called us guys. I'm sorry. What Salvador is asking, I suspect, is buying calls, right? Buying calls is clearly speculative, because if you're buying a call that's out of the money, 100% of the cost is time premium. And time premiums, what do? They evaporate over time. And so when I buy calls, I tend to be very, very selective. I mean, I will sell puts on stocks I like all day long, but buying calls is something I do rarely. I do it very selectively. And one of the things I found over time is I never wait till expiration. You know, I will always sell that call, whether it's going in my way or against me. I'll always sell that call months ahead of expiration, because as you get closer and closer to expiration, then the time premium evaporates completely. And if you're out of the money, even by a little bit, your option can go to zero pretty quickly. So we bought, just to give an example, about a month ago, I bought a bunch of calls on Barrick. And the reason I was buying the calls on Barrick was because of all of the major mining companies. I don't just mean the top three, but of all of the major ones, Barrick was seen as reporting disappointing first quarter, right? So they reported disappointing first quarter. I don't think they were as bad as the market perceived.
I remember
But
reading about that when you said it.
The market thought they were disappointing and the stock went down. My thinking was that with the second quarter gold price being $250 an ounce higher than the average first quarter selling price, my thinking was that Barrick would have to really mess up badly not to have a good second quarter. And so the market would respond positively, because Barrick was kind of in the doghouse. So that was my thinking. I bought a bunch of calls. They were all close to the money. I mean, I bought some 18 Septembers, for example. I didn't go far out, because I was making a bet on a specific thing, but the second quarter earnings would be favorable and the stock would move up. And I've already sold about 2/3 of them. You know, I'm not waiting for, you know, the big payoff.
Yeah.
Anyway, that's the way I play options.
Gotcha. Hopefully that answered your question, Salvador. Peter, yes, got you from Slovakia, but in the UK. By the way, was a pleasure watching the European football finals.
No, it
Slovakia,
wasn't.
well, it was a lot of good soccer. I mean, I've been playing since I was 5. England did very, very well. Didn't quite get it done against Spain. Slovakia had some really good games. So thanks for that, for what it's worth. And Peter's a big fan, and we're a big fan of you. So Tony says, have you heard much lately any discussion on digitizing gold coin collections? Think blockchain, not a gold-backed crypto, but actual shared ownership tracked on blockchain. Not that I think that is the best way to hold it. Okay. I have not. But I expect it's coming. You know, we had some of these conversations at the Rules Symposium last week, and it kind of reiterated some of my thinking. You know that you know I'm not a crypto guy. Um, I think it's going to be around. We've talked about this, Adrian. You know, I don't know exactly what its role will be in the future. What really gets me excited about crypto is the blockchain technology, and I think anybody that looks at that space, that's really what's got to get you excited. It's because I see a world where everybody is trying to go peer to peer to do business, no matter what it is. It could be a light bulb, it could be gasoline, it could be, you know, a home loan, whatever. Everybody wants to find a way to do business peer to peer, cut out the middleman, do business directly. And blockchain is the tool that's going to let you get there, right? So I would not be surprised if that's going to emerge. I mean, we're already seeing what NFTs and things of this nature, where you can have either complete or partial ownership of various things. It could be a concept, it could be an actual item, what have you. I don't I don't doubt that that's where things are headed. I have not heard anything specific or concrete in the development. I don't know if you had, Adrian.
No, I have nothing to add on that. I'm afraid. Although I can add, I can say something about the next question if I may. But no, I'm not. I know
Okay,
nothing about the digitization of
then
gold.
I'll let you handle Scott's question. Then how's that?
Well, we'll both do that. Will
Okay.
BRICS adopting a gold-backed currency cause a rise in the gold price? I mean, I'll answer your question, yes. But you know, I think people who are, and I'm not suggesting you are, Scott, but people who are looking for the BRICS to adopt a gold-backed currency imminently, and that to cause gold to go to 5 or 10,000, I think that's a mistake. So I think it's going to be at the margin. I suspect, but if we ever get to the point where the BRICS actually adopt a currency, because I mean, at the moment, it's just individual currencies, individual countries that are putting some gold backing. Gold will only be one component of the backing. I don't think we're going to have a gold-backed currency anytime soon. And I don't think the BRICS are going to adopt their own currency anytime soon. But all of these things, whether it's Malaysia having putting gold backing, whether it's Saudi Arabia, all of these things, and whether it's China and Saudi Arabia buying and selling oil in yuan instead of the dollar. So all of these things are perhaps relatively marginal in the overall scheme of things, because the US dollar remains by far, well, it remains the largest trading currency by far.
Yep.
I think it's something like 75% of the world's trading is still done in dollars. And it also remains the largest reserve asset.
Yep.
It's about 50% right now. So, and that's what I'll call them, the apologists, but that's what the apologists for the dollar will say. You know, the dollar is still the dominant currency. Yes, it is. But look at where it's come from.
Yep.
You know, I remember when I was in this business back in the 80s and 90s, you know, the US dollar was about 80% of the world's reserve currencies. By world's reserve currencies, I'm sorry, we mean other than a country's own currency.
Yes.
The Singapore dollar for Singapore's national bank, and you know, so on. But for foreign exchange, for foreign reserves, it was something like 80%, and it's come down meaningfully. And when you think the central banks tend to be, you know, changes in central bank reserves tend to be slow. It's not like me just waking up one morning and saying, I don't own NVIDIA anymore, but I think I'll buy, you know, Agnico Eagle. I mean, their changes tend to be slow. So for it to come from 80% down to 50% in 30 years is really quite dramatic in the long scheme of things. And the same goes for trade. You know, you're seeing a lot of bilateral trading agreements. So it's all incremental. but it's happening. And you know, Hemingway's quote on bankruptcy has been a little bit overused, but it's still a good one, right? How
Yeah,
do you go bankrupt? Slowly at first, then suddenly.
and all at
And
once.
that's how a currency loses its reserve status.
Yeah.
Slowly at first, and then suddenly.
Yeah, and I agree with you, Adrian. I'd make the argument that, you're seeing it right before our eyes. I mean, when we look at central bank purchases over the past few years, I mean, the largest purchases of gold by central banks 2 years ago in 60 years of keeping track. And then last year, we just missed it by about 4% or 6% or whatever the hell it was. We were only 94% of the year before. And so far, first quarter of this year, we're ahead of the game from last year. Right. So central banks are buying, and maybe there's not a gold-backed currency to put this behind, but I think they see the writings on the wall, and they're preparing themselves for what they see as kind of a sea change. So I think this slowly at first is happening before our eyes right now.
Absolutely.
And it's what has been propping up the gold market for the past few years, in my personal opinion.
No, absolutely, absolutely. And of course, there's a lot of reasons for this. One is just the mere fact that they want to diversify.
Yep.
Again, you know, when you have 80% of your foreign reserves in a single currency,
A single mismanaged
standard,
currency, I might add.
Sorry?
A single mismanaged currency, I might add.
A single mismanaged currency. You know, that's the kind of thing the SEC wouldn't like if they looked at my managed accounts and we had 80% in one asset.
Yeah.
Secondly, the US dollar is arguably becoming more mismanaged than it was back in the 80s and 90s. And then thirdly, of course, we have the weaponization of the dollar, which has been going on for a long time. Actually, I don't know if you read Bill Bonner's, does he call it the Daily Reckoning, or has he changed the name now?
Is the Bonner? It's something
anyway,
different now, but
his
I get
letter
it
this
every
morning
day.
was excellent, and it was actually just talking about this point, how the US and the attitude of foreign people to the US has changed. Remember the attack on Swiss banking secrecy? You know, and the US imposing its own rules, as well as its own sense of morality, on other countries. And, you know, frankly, I don't know why other countries just went along with it so readily, especially, say, Switzerland. Switzerland, as you know, represents the US. It has consular representation in countries where the US doesn't have embassies. So, you know, they're allies. Switzerland is doing things for the US, and yet, you know, they were pushed. I won't say they meekly submitted, but they were pushed, and they've changed their whole way of doing business. So we've seen a lot of things like that, and we don't need to go into all of them. You know, remember Banco Santander, which lent money to a Spanish real estate developer to build a hotel in Cuba, which was legal under Cuban rules and legal under Spanish law, legal under EU law, and even legal under the international, you know, under the United Nations. And yet, because it broke US sanctions, and no US company was involved, the US decided to fine Banco Santander, and it could do it because it uses the SWIFT system. So people get a bit tired of that, to be honest with you, being bullied like that.
Friends and enemies alike.
Sorry?
Friends and enemies alike.
Friends and enemies alike. And so moving a little bit away from the dollar and having some assets that are outside of the control of the US is just prudence, just as it is for you and I mean, sorry, for you and me. Whoops. Just as it is for you and me.
My mom would have corrected you.
Well, I got it immediately. So too is it for countries, you know, even if you're allies of the US, just to have a little bit of protection.
They want their plan B. They want their foot in the door before the door gets slammed shut too, right? So same kind of concept that works at the global level as well. I see a question here from Leonard, and it's kind of a shift, and I want to cover this. I knew this was coming up. I didn't know when. But before we do, I just want to say something for the folks that are with us, folks that came in late. I know you're looking to see Larry McDonald. For whatever reason, he wasn't able to connect. We'll try to get that rectified somehow. I'm sorry we missed out on him tonight, but we're having a good conversation. Two other things I want to say real quick is, we're going to go ahead and capture this for those that want to refer back to it. We're going to send it out tomorrow to all those that registered, not just the attendees. We always do that. So you'll get a full copy of the webinar that you can go back to. We tend to make some offers, and there will be one at the very end today. I'm gonna make it easier for folks to own precious metals, as I always try to do on these things. But I also want to just get it out there right now before we lose anybody, that we know who our next guest is. It's going to be a pretty good one, don't you think, Adrian? We spent some time with her down in Boca Raton last week.
I think so.
Yeah, so on Wednesday, September 25th, Adrian and I are going to welcome Nomi Prinz. So Nomi is now with Global Prinsights, and you all know her very well from Legacy, and it's Nomi, Nomi Prinz, Prins, right?
Tony's happy.
Yeah, yeah. So Nomi's going to be with us. Really looking forward to that conversation. She's a special lady. I got to know her a couple years ago, at the Rural Symposium. We struck up a bit of a friendship. I know Adrian's known her for some time. One of the brightest minds out there. So you're in for a treat on September 25th. Make sure you sign up. And with that, I'd like to go ahead and get on to Leonard's question, unless you want to add anything to that.
No, the only thing I'll say, which I always say, is if anybody has any questions that occur to them afterwards, always feel free to, email either to me or to Rich, and I'll, respond to the email that comes from Rich. I'll do my best to answer what I can.
Oh, and same here. So Leonard's asking, will the U.S. election be a catalyst for serious civil unrest? And how will this affect the precious metals and commodities in general? Will a Trump victory be any sort of hedge against further geopolitical unrest? And I think that's a well-timed question given the events of Butler, Pennsylvania over the past weekend. What do you think, Adrian?
It is. I'm still looking to see if any message from Larry. Sorry. Are you turning the political questions over to me?
No. I think we both get a shot at it. You want me to go first?
I don't mind. So I'm going to try to be non-political, more analytical. I know I've mentioned this on this webinar before, but I think something very stunning when we talk about civil unrest. There was a survey, there's a political institute at the University of Virginia that's very well respected. Larry Sabato, Larry Sabato, he's on the radio, on WTOP occasionally.
Yep.
And they're very, very well respected. To be honest with you, I used to listen to Larry Sabato every week, for 10 years. And I never really knew if he was Republican or Democrat. And so that's a good sign of a good analyst, in my view. Yeah. Anyway, this political institute run by Larry Sabato, they asked registered Democrats and registered Republicans a simple question, very simple. Do you think it would be moral to use violence to prevent, Republican or Democrat, depending on who they were asking, to prevent the Republicans from taking office if they win the election? And over 40% of Democrats said yes. And it was almost 40, it was about 38% of Republicans said yes. So essentially 40% of the registered Democrats and Republicans are saying that violence would be justified. Justified was the word, I'm sorry. Violence would be justified to stop the other side taking office if they win. That's astonishing. Now, not all of those people are going to grab their gun and go out shooting, of course not. But the mere fact that people would even answer that question, yes, is disconcerting. Yeah, I think there is a risk. Obviously, an awful lot depends on what plays out between now and the election, and also, you know, how fair the election result is seen as. And those are things we just don't know. But I think there is a risk. I mean, clearly, any civil unrest would be a positive for gold in particular, gold and silver in particular. Other commodities, I'm not sure. You know, I mean, there's so many questions here, like how serious is the civil unrest? Does it lead to a serious downturn in economic activity? If it leads to a serious downturn in economic activity, then that's not positive for copper and other base metals. But for I think the answer for precious metals would definitely be yes. And would a Trump victory be any sort of hedge against further geopolitical unrest? You know, we're moving in towards politics here, which I try to avoid when I'm talking about when I've got my investment hat on. You know, I'll just say this: for whatever reason, when Trump was in office, Putin did not decide to invade Crimea. He invaded Crimea. Let's not forget, his first invasion of Crimea was when Obama was in office. Trump came in, nothing, and then they invaded. The number of missiles launched by North Korea went down sharply. So I'll say the activity in the Middle East went down significantly. And of course, we had the Abraham Accords. And I'll say for whatever reason, it could be because Trump was just buddy-buddy with good old Vladimir. I'm not saying that that's what I think. I'm just saying for whatever reason. I'm not trying to make a political comment.
You don't have the answers. You're just making a commentary or an observation.
Maybe all these leaders saw Trump's mad, and we don't know what the madman will do.
Yeah.
But for whatever reason,
the tiger, yeah.
We did have lower geopolitical unrest, and I suspect we could see the same. We could see the same if he comes back to office.
Yeah, it's kind of interesting. So two things. First, I wholeheartedly agree with what you said, Adrian. When peace breaks out all over the world, that's not typically good for gold, right? Whether it be domestically or internationally, it's not typically a good thing for gold. I'm going to share this with you, and I don't want to get political either. I'm apolitical. Anybody that heard my presentations ever know that I blame both parties for overspending on the horrible state of the dollar in our economy right now. But I have a friend in the industry who shared this with me, and I asked him, we were in a conversation after President Trump won election. If you recall, leading up to that, gold was doing pretty well. It was on the move to the high side. He was elected, and then gold ended up moving down or kind of leveled off. And I said, why is that? It doesn't seem to make sense. You think it'd be positive for gold. And he said, I have a theory. Not my theory, my friend's theory, who will remain nameless. He basically said that Democrats don't buy gold, libertarians can't afford gold, and Republicans only buy gold when they're scared. And then once Trump won, they were no longer scared. Now, that is one person's thought. He happens to be a man, it's one man's thought. But I will tell you, as a gold dealer of about 28 years now, I have sold plenty of gold to Democrats. I've sold plenty of gold to Republicans, and I've sold plenty of gold to libertarians. So they all buy gold. They do all have money, and they all see the value. Of course, we sell it as insurance, and it's not really a hedge against unrest, et cetera. Although that's when you tend to see the prices move. So I don't know if that answers your question, but I thought you might appreciate the little vignette. So.
No, that's good.
Okay, and yeah, it surprised me too. The comments on violence, no question. I have no idea who that was, and laugh when I hear that. Okay, well, good. So at this point, we've run through the questions that are posed to us.
I did have one other
Yeah,
thing that was in the question earlier on
sure.
or a thought came up on silver. You
Yeah,
know, when we talk about silver being more leveraged than gold, the same, of course, applies to silver stocks. And there's two reasons of that. First of all, there's reasonably or very few real silver companies. I mean, you know, you can think of 30 silver companies. There are thousands of gold mining companies. So when people want to buy a silver stock, there are just that so many fewer, far fewer to pick from. So the money gets concentrated more. And the other thing, again, my comment on silver being a byproduct metal, there are very few mining companies where the majority of their revenue comes from silver. And that's true even of mining companies that have silver in their name. Some of you will know that, you know, I like Fortuna a lot, and Fortuna has just changed its name from Fortuna Silver to Fortuna Mines. They did that last month. But if you look at this year, last year, the year before, they were only getting about 20% of their revenue from silver, but most of it was coming from gold. And yet, when silver moved, the stock of Fortuna would move. And that's because there are so few silver companies and people just go to the names they know.
yeah,
American Silver, Coeur d'Alene, Hecla Silver, etc. Whether a majority of their revenue is gold,
yeah,
or silver, whether they're good companies, bad companies, and I'm making no comment on any of those at the moment. I will if you want. But, you know, they go to those names. And they also went to Fortuna Silver, just because it's got silver in the name. I think they were right to change the name because, you know, they have a minority of their revenue from silver, and that'll stay like that for a while. So anyway, that's why the silver mines tend to be much more leveraged. And we saw it, for example, Pan American Silver, which has the largest reserves and resources of silver of any mining company. Their stock price basically doubled over the last 12 months from an admittedly rather exaggerated low point, but nonetheless, you know, it's up almost 100%. So these stocks tend to have very large moves. You look at First Majestic, which is now a pure silver company, and Keith Neumeyer, the CEO of First Majestic, is very vocal about supporting silver,
yep,
very vocal about the manipulation of silver and so on and so forth.
yep.
So silver, I'm not making any derogatory comments. Silver bugs like him. You just look at the way that stock moves when silver moves.
Gotcha. Thanks for your comment, Tony. We try our best. And David had asked about platinum, which we hadn't talked about yet tonight. He said, what are your opinions about the future value of platinum with its use in catalytic converters and a seeming rise in returning to hybrid vehicle manufacturing in the US as well as in China? And also the need for it in jewelry as well as developmental use in hydrogen production. So a lot to unpack there, all the different uses of platinum. Interesting metal. I could start a little bit on this. You know, it's been kind of an enigma to me. When I first started in this business 28 years ago, platinum was my favorite metal. There's no two ways about it. It's why I have a platinum, you know, wedding band. It was the most expensive precious metal. Its supply demand fundamentals were solid, really easy to make sense of. There was no question what was going on there. And, you know, somewhere along the line, about, you know, 5 to 10 years ago, I forget exactly when it was, palladium inched ahead of platinum, and we thought, okay, this has happened before. It usually lasts 2 to 3 weeks, and then, you know, platinum's going to go higher. And 2 to 3 weeks turned into 3 years, and, you know, 2 to 3 more years and 2 to 3 more years. And finally, just recently, platinum has inched back ahead of palladium. And a lot of that has to do with the industrial demand for the two metals. Some of it, I'm sure, had to do with the supply. I want to say that Russia is, you know, Russia and South Africa are the two primary producers and exporters of platinum and palladium to the world. I'm pretty sure Russia holds the baton, if you will, for palladium, and South Africa holds the baton, if you will, for platinum. But the two of them by far outpace the rest of the world in terms of their exports. And I think that may have something to do with what, the palladium price, over the past, few years at least. But we may be running out of, above ground stockpiles, and therefore the platinum price might be coming down. I'm not sure. The bottom line is, I still like platinum. People asked me at the conference if I was, interested in an investor in platinum, and I just think personally that, those are industrial metals and they're industrial cases, and you can certainly buy into that. But I think the case is much stronger right now for the monetary metals, gold and silver, than it is for industrial metals. And that's where I'm putting my money in gold and silver right now. So I still like platinum. Um, it's just harder to read. Some of it is the games that can be played. I don't know if everybody's aware, but Ford Motor Company almost went out of business because of platinum and palladium, right? They can be substituted for each other in certain applications, specifically AutoCAD. And there was a period of time where Russia basically stopped exporting palladium. They said, we're not going to do it anymore. And at that time, I want to say it was like 120 to 140 an ounce. And they basically said there were bureaucratic wrangling over quotas, and they couldn't get their act together, and they couldn't figure out what they were going to do, so they just weren't exporting anything. They did that for about a year, and the price got up to 1,075 an ounce. And then magically they figured out the export quotas, and within a year, guess where the price was? 120 to 140 again. And you can't just flip a switch and say, okay, today we're going to use platinum for AutoCADs, and tomorrow we're going to use palladium. So what happened is there was basically a move to palladium at the lower price as a substitute by Ford Motor Company. They were stuck with that decision while Russia played these games. So I just have issues with that. I don't know your thoughts, Adrian, but I like the metal, but in this environment, I like gold and silver better.
Yeah, no, absolutely. And when it comes to physical, I much prefer gold and silver. There's no question, for the reasons that Rich just said. And I'm more of an equity person, and I'm just not a big fan of most of the large producers of either two of those metals, for a lot of reasons. I mean, we've owned I've owned some of them. SBSW, I can't even remember the name now. One of the problems when you manage money and stare at a Bloomberg all day long is you can remember symbols, but you can't remember names anymore. But they own Stillwater, the largest platinum palladium mine in North America. Yeah. But I'm just not a big fan of the mining companies either. So I have tended, not to devote a lot of time to either of those two metals. They're difficult to read. I agree with you. You have both supply and demand characteristics that make
a lot of variables, unpredictable.
I prefer to get my exposure through royalty companies. Gotcha. So Franco-Nevada, for example, has a royalty on the Stillwater mine. And so that's how I prefer to get my exposure.
You get the benefit, but you get insulated as well. I like that. So.
Yeah. And that's the way, frankly, I get most of my exposure to, say, lithium and cobalt and other weird and wonderful metals. One of the problems with looking at pure lithium mines or pure lithium exploration plays, as we have seen in the last couple of years, the price can be very, very volatile. And these metals can come in and out of favor among investors. And then over time, of course, new technologies can come along that actually reduce their actual importance, not just for investors, but their actual importance. So, I prefer to look at companies looking for lithium who are also looking for gold and copper, and companies that own lithium mines that also own other mines.
Gotcha. We have one more question. I think we'll probably make this the last question. We're coming up on the half hour here. It's been about an hour and a half from Adrian, and then we'll afterward, Adrian, maybe we'll switch to your parting thoughts, and I'll do the same. But Adrian asks, in a bull market for precious metal stocks, will some new majors appear in the next 3 to 5 years, or will the same old names still dominate the sector? And I think I know the answer, but I want to hear your thoughts here.
Well, that's great name, by the way. That's an interesting interesting question. I mean, I think the likelihood. I mean, the last time we had this huge revolution in the leading gold mining companies was, of course, when the South African miners in the 70s lost prominence because of the decline in gold production or relative decline in gold production in South Africa. I think we're going to see mergers. So it may be, and this isn't exactly what you asked, but it may be if we look at the top 10 mining companies today and then look at the top 10 in 3 or 5 years' time, some names won't appear because they've merged. But I suspect that the same companies, Newmont, Barrick, Agnico, Kinross, Anglo, Goldfields, I suspect that those companies will still be at least in the top 10 in 5 years' time. I'll say a couple of other thoughts. So one is, as we know, some of the major gold mining companies that do like to get bigger, like Barrick and Newmont, are moving more and more into copper. That's just one point. And so we may find that if we're looking for more pure exposure to gold, we will be looking at different companies, different names than we are looking at today. The other thing that I think will likely happen, I mean, I think it's quite possible, but we will see some of the mid-tiers today move up to, let's call it, junior major status. Some of the companies, I don't know, like B2, for example, that has multiple mines in different jurisdictions. If they just continue to grow, continue to have acquisitions and bring new mines in, they will become a much larger player in the world. But I don't think we'll have I think we'll see the same old names dominate the sector.
Yeah. That's exactly what I thought you were going to say, but I appreciate the added insight. So with that, Adrian, thanks to Adrian and all the other folks that asked questions today. We really appreciate it. They were excellent questions. Hopefully that we were able to share some insights with you that were meaningful. What do you want to leave everybody with, Adrian? And be sure to let everybody know how to find you as well.
Yeah, well, I'm sorry again that something happened with Larry. I apologize there, but we'll let you know. Yeah, I guess the parting thought. Listen, the parting thought I'll make. We didn't talk about this, but I think this is an extremely. This is an unusual opportunity to get into gold and gold stocks. It's unusual. I'll let you address gold maybe, but it's unusual for gold because gold is moving up even without any Western investor or very little Western investor participation, and with continued outflows from the GLD. So just imagine what's going to happen when Western investors finally decide to buy. When you come to gold stocks, yes, the gold stocks are up, what, 24% this year, 25% this year? Not bad. That's not bad at all. But typically at the beginning of a gold bull market, the gold stocks well outperform gold. So you go back to 1976, you go back to 1980. In 1980, gold was up 12% in the first 3 months after it bottomed, and the gold stocks were up over 50%. So the leverage is normally astonishing. And you saw the same thing in 2008-9 after the correction with the great financial crisis. This time, gold stocks have barely outperformed gold. And if you look at them over a 1-year period, they haven't outperformed at all. So they barely outperform. So the opportunity now, when gold is at all-time highs, but gold stocks are still trading at multi-decade low valuations, I think is just an astonishing opportunity. People can get hold of us from, let's see, the website is adrianday.com.
Fantastic. And I was gonna say, boy, that's great advice. I just wish there was some way we can find somebody that could help us pick those stocks. But thank
I
you.
wonder who that might be.
Adrian is that guy. There's no question about it. I'll go ahead and add on to what Adrian said. I think it's an incredible time for physical gold and silver right now as well. I started the show with it. I'm going to finish it. I'm going to keep saying this for I think years to come. Gold at all-time highs is dirt cheap. We consolidated for 5 years not to go down. We consolidated at all-time highs for 5 years to build that support for the next leg up, and we're starting to see that materialize. And then silver at 60% of all-time highs is even cheaper. It is just now, this year, starting to exert that relationship of follow gold and start to outpace. And it is more volatile, so it'll run a little, it'll pull back a little bit more. But I do expect to see silver take off from here. What I love about both metals right now is the fact that the Western investor is not in this. Right. So even though everybody says high prices, I think they're dead wrong. Cheap here. The prices. What we're not seeing is that demand for fabricated coins and bars. So the premiums are also extremely low right now. Once that Western investor gets into this market and starts demanding coins and bars, those premiums will expand, as will the price, and both things will start moving up from here. Right now, you've got a bit of a window where both are dirt cheap. And I strongly suggest that people take advantage of that. What we're going to do to try and entice you to take advantage of that is we've got an offer, and we'll put it out in the email tomorrow, but you can call us, when we open up in the morning. Anybody that's interested in buying gold or silver, you spend $5,000, we're going to give you free shipping, handling, insurance, and a free gold eagle, or not gold eagle, oh my God, a free silver eagle, okay? Like Michael did for Adrian at Freedom Fest. We're going to give you a free silver eagle and free shipping, handling, and insurance on a $5,000 order or more. So just keep that in mind. We're trying to make it easy for you to take advantage of these opportunities here. As always, you can reach us through email, info@assetstrategies.com. Go to our website, assetstrategies.com, or call us toll free, 800-831-0007. That is 10 better than James Bond. I think it's an amazing time to be owning stocks and physical in precious metals. And I'm glad you joined us. Hopefully we've imparted that thought to you as well. I see there's one more question. Thank you both. Looking forward to hearing from Nomi. Yes, so Wednesday, September 25th, Nomi Prinz will be our guest, and we look forward to that. And for all of you coming back, and bring your friends, let them know. Adrian, any parting thoughts?
No, you've handled everything. Thank you.
Fantastic. Thank you all. We appreciate you, and we look forward to the next time.
Thank you, everyone.